Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the news that moves the markets. And it's been a heck of a news week. Again, we had a big week last week. We've had another big week this week. And I got to be honest, guys, I'm in desperate need of some sage wisdom. So I went out and found the sagest of wisdom and asked Rob to join me again this week. So Rob, thanks for coming in again.
Glad to be here, Miles. Got a lot to talk about.
Yeah. First, a quick note to any of our listeners. A lot of you have called in over the last week or so doing some credit safety ratings of banks, giving us a chance to kind of look through the bank book, see how you're doing, see if there's any major glaring problems with your personal bank. Some of you might still be waiting for a callback on that. We are getting through you as quickly as possible, so we appreciate the patience on that. And if you're still waiting for a callback on your bank rating, I promise it's coming. So thanks. Now, with that being said, Rob, you've been doing this a long time and you've seen a lot of market capitulations through your career. I haven't. I'm 20 years in. I've never been in this industry in a rising interest rate market. And lo and behold, despite what's happening in the market today in the banking industry, we got another interest rate rise today. What the heck should I be looking out for?
Well, let's look at the 10-year. Interest rates went up 1/4 point. The yield on the 10-year is actually down about 16 basis points. And the value of the 10-year is dropped. And then what you should be looking at is...
Yeah, that makes no sense.
It makes no sense, but I guess it happens. Now look at what the Fed is doing. The Fed is stepping into the bond market. They have ratcheted up their balance sheet. It looks like a rocket going straight up. They've added back 50% to the balance sheet of what they had taken off the balance sheet during their quantitative tightening. Well, now it's quantitative easing with a vengeance. You'll show that chart. It's astonishing.
Right. Well, we were prepping for this. You sent me that an hour or so ago, and I think I hollered down the hallway, Rob, where did you find this? Because I pulled it up on my charting software, and you're absolutely right. We've said for months, you can't just do the one thing of raising interest rates. There's a couple pieces to this puzzle you've got to do. And Jerome Powell has agreed. You have to start tightening up the Fed balance sheet a little bit.
But he's going the other way now.
Yeah, in fact, he's going the other way so fast. Everything that they've unwound since April of last year, they gave up half of it today.
Yeah, it's just out of control. So what you're dealing with is an economy that is struggling to absorb these higher interest rates, but you're dealing with a population that's struggling to accept all the new changes that are occurring. People are losing faith across the board, whether it's in faith in the media, faith in the educational system, faith in government, faith in their currency, faith in their bank, faith in the stock market. People are losing trust, and this is bigger than just a banking crisis or just a interest rate rise. This is broad scale.
Right. Across the board and not just limited to the financial sector.
No, not at all.
So there's a quote I've always liked, something along the lines of politics flows downhill from culture. And I'd guess finance flows downhill from politics, which is downhill from culture. So there may be, like you said, this is a much broader problem with a much deeper concern than just SVB Bank going out of business 2 weeks ago.
And we're just talking domestically. If you look internationally, you have a lot going on in the international scene. Concerns about Israel and Iran, concerns about Russia and Ukraine and dragging in NATO, concerns about China and Taiwan and what's China doing with Russia now. There's a lot going on, and the military-industrial complex is definitely ramping up for something.
Right. Even here domestically, with the Fed balance sheet, as you just pointed out, we had about a $500 billion rise in the Fed balance sheet. But we're still looking at an equity market decline in the same time period.
Yeah.
So they pump $500 billion into the market to try to pop it up, and we're still looking at decline.
I think the Fed had to step in to the bond market and buy up all these bonds that nobody really wanted to buy. And usually that's a sign that, hey, the punch bowl is getting filled back up because they're paying these entities, these banks and institutions, face value for bonds and treasuries that have lost ground because they have embarked on the raising of interest rates. And now the market value of those bonds is dropped quite a bit in the last year and a half.
Sure.
But they're paying full face value.
So now this is going to be an obvious tee up, so forgive me. But if we're looking at a situation where interest rates are rising, which again, kudos to Jerome Powell for sticking to his guns, at least in one piece of this, although I would argue that simultaneously going out and buying $500 billion worth of equities for the balance sheet kind of offsets the quarter point rally at the same time in the interest rate. But like you pointed out, we're looking at declining yield. And I'm looking at a U.S. dollar index that went down today as well.
Yeah.
So where's the safety net?
Honestly, if there was a better vehicle to be in besides gold, we would be doing it.
Yeah, and apologies for the obvious tee up there, but gold's the only thing up today.
Yeah.
And I think what I find interesting about that is something we've talked about for a long time is I tend to err on the side of markets are going to do what they're going to do, and news events don't really change the direction of an overall trend.
They just exacerbate it, yeah.
Yeah, they either speed it up or slow it down.
Mm-hmm.
Except, and there's always a but with every rule. Go back to English classes when you were a kid. There's always a but, there's always an exception to every rule. And I think the exception here is when logic and reason and investment mindset just turns into panic. And could we be seeing that same type of transition from reason to emotion like we saw in 08?
No, and I'm seeing that. I mean, I have to talk people off the ledge constantly because they're very concerned about the central bank digital currency. I know there's legislation that Senator Cruz is putting forth to disallow this administration to create the central bank digital currency. But we're still several years away from that occurring. I know Bill Gates was talking about artificial intelligence, how that's going to change everything within 5 years. Well, they need AI and quantum computing to institute a blockchain digital currency on the US dollar. They can do it in Ethereum and Bitcoin because compared to the US dollar, you're comparing a bathtub to the Atlantic Ocean. The US dollar being the largest asset class in the world, they physically cannot create a blockchain to the dollar yet on the broad scale. They can do it in a limited universe, but not in the big world. So people are panicking about that because they're so concerned that the government will now control all their money. Yes, they want to at some point. I remember when Joe Biden 2 years ago said, hey, I want all the banks to report any transaction over $600. I got a letter from my bank, the Bank of Colorado, saying, hey, we cannot do that. We do not have the manpower to create those reports. That's not, hey, we disagree with the objective here. They're just saying we cannot do it. Well, they cannot create a central bank digital currency in the broad ocean of the US dollar. It doesn't mean that they're going to stop. They're going to continue this because of what it means to them, because this way they would eradicate the use of stacks of green paper. We wouldn't have money in a bank. We would have our money with the Federal Reserve, and it would all be on their balance sheet, and they would be able to see everything. And that causes great concern to a lot of our listeners and clients. But I'm like, we're not there yet. They'll get us there eventually, but we're not there. And we're not at a place where all these other trends are taking over, but it's very concerning. And so we try to not create a panic. We're telling people, hey, the banks aren't going to collapse, but the smaller regional banks and the local banks will eventually, over the next few years, more than likely get absorbed into the big monolith institutions.
Sure, and it doesn't hurt that we've recently heard, say, Janet Yellen alluding to the idea that not everyone's created equal, and some banks deserve FDIC bailouts over and above the $250,000 limit, and others don't. You know, it's funny. One of my first concerns when the SVB thing first happened is, okay, there's no more accountability ever. Because all of a sudden, every banker in America can do whatever they want because the FDIC is going to step in and back everything. And then it comes out that they're not going to step in and back everything. They're going to step in and back SVB, but they might not step in and fully back beyond the FDIC limits, your local bank. So again, we're getting a little bit into the conspiratorial weeds here, but I do think it's a progression. You know, one thing I tend to look at is I don't think we wake up to the financial Pearl Harbor where everything's fine and then it's not. I think it is a progressive event taking place, and we're seeing that right now.
I agree.
Because there's a lot of money switching between banks right now. And I'm shocked at the amount of money that's going from small local banks into the big boys.
Right.
Because they have a greater sense of additional FDIC and government protections with the big guys than they think they're going to get with the local guys. I feel like you should go the other direction. Go with the small, conservative, fiscally responsible local state bank. But a lot of people are going the other direction.
Yeah, and a lot of people are buying gold right now too.
Yeah, lo and behold. Interest rates go up and yields are down. If you can't even trust to get a higher yield, what can you get into? Well, not only did gold have the breakout move that you and I talked about 2 weeks ago, we came back and had our retest, which I said I'd like to see happen, and I didn't believe it could hold here. And as of today, we've bounced that retest. So we've put in a higher high. We've had a short-term retest. And if we see gold push above the high we put in, I mean, now we're over 2,000, or at least we would be if we push above the high from a couple days ago. Yeah, the next stop is far beyond what the old-time highs were. I mean, you could be looking at the next move up in gold, this Elliott wave. A couple weeks ago when we were talking about Elliott wave theory, we could be looking at a Elliott wave C wave that's pushing gold into the 2,300s just on this next move.
Well, I just got off the phone with one of my largest clients, millions and millions of dollars in our products. But we were at 2,000 in 2012. It fell all the way down to just under 1,100 and then back up to 2,000. We've hit there a few times. It cannot seem to break 2,000. What is going on? I'm like, well, if we go back to the first time we hit 2,000, what was that, 2012?
2011.
Yep. Okay. So 2011, and I actually did this work, and we've talked about this before. So we hit 2000 for the first time in 2011. Here we are in 2023. How much debt have we added since 2011?
Much. I don't know the number.
16, 17 trillion.
Right.
Now that's more than all the gold in the world. Just of what we have added to the debt.
Just our country.
Just our country.
On our domestic debt.
On the federal debt. How much currency did we create since 2011?
Also much.
For over 14 trillion. I mean, look at the balance sheet. How do you think they bought $500 billion worth of equities off the market just in the last few days?
Well, same way you and I do with savings we had in our deposit accounts, right? with money we have in the black that's savings that we've worked to. That's how it works, right?
Right. No. Well, we don't have a printing press in our basement, Miles. So they created another $500 billion, bought the bonds off the market. Now, 14 trillion is a whole bunch of money, and I bet you that figure is higher because you now have a $6 trillion Biden budget. I think it's actually pushing 7 trillion when you figure it all out. How much gold came out of the ground since 2011?
Not that much.
$2.4 trillion worth. So the growth of debt just in the U.S. and the growth of currency just here in the U.S. is 5 to 7 times higher than all the gold coming out of the ground. What I tried to explain to my client is like, look, technically, fundamentally are two different things. I'm looking at it both. We're looking at it technically, but fundamentally, we're looking at a huge increase in our currency base and our debt, and a very small addition to all the gold in the world coming out of mining operations. So we know that this next move, like you said earlier, we're not going to just hit 2,000 again and fall back. We're going to go higher because there's so much more money that we have created than there was 12, 13 years ago.
So, Rob, do you think it's fair to say, because again, you know, I came into this industry about 18 years ago, so you've got an entire market cycle that you've gotten to watch this prior to the one I have. Would you argue when you're looking back through the 80s, 90s into the 2000s, did you get the same question about $800 or $1,000 gold?
We did. Absolutely. When's it going to go to 800 again? Well, when it gets there. And then we got to 1,000. And then the stock market came apart and it fell back to 750. Within 6 weeks, the price of a Krugerrand was 1,050. And the spot price hadn't really moved much. It was around 800. I had a client said, "You're charging me a $250 commission for a Krugerrand? Spot's only 800. I'm like, "No, I'm charging you a $50 commission, 5%. Krugerrand cost me $1,000. That's what the price is on the market. I'm adding $50 to keep our lights turned on." And people had a hard time understanding that. Well, why is it so much more for a common Krugerrand than what I see posted on the price of gold? And we saw that again during the COVID crisis. Gold hit a high and then it dropped during the market panic. Within days, both the futures price and the physical price were higher, and the physical price began separating. Look what's happening with junk bags of silver right now. Can you find me 10 bags of junk silver, Miles?
I can't find you one.
There are no bags of junk silver in the marketplace right now.
I take that back. There are some companies that will pre-sell them to you, but it's 8 weeks delivery.
Hoping in 8 weeks they can fulfill that order with a product that hasn't been minted since 1964, because junk silver is not scrap. Those are the old dimes and quarters. I would not want to go short bags of junk silver, even paying the kind of premium that people are having to pay.
Sure.
Because they're paying, golly Moses, about a 20 to 25, it's about a 25% premium over what we would charge.
Yeah, it was about $5 an ounce from a competitor that I was looking at in 2 months on delivery. So yeah, that's product they don't have.
No, and it's not made anymore.
No. Well, now what's interesting about that is if you're currently a junk silver owner, in about 6 to 8 weeks, a lot of companies that have pre-sold that junk silver are going to have to go find it at whatever price they can.
We did this last year.
Yep.
We would contract because, we work in an industry where people contact us. "You have any Silver Eagles?" "Yes." "How many do you want?" We contracted over 400,000 Silver Eagles, and we were able to exchange 750 Silver Eagles for a 1,000-ounce bar. And then we did the same thing with junk silver bags. The premiums on junk silver bags got ridiculous, but we could only do maybe 60 bags or 80 bags before they said no more. We have access to so much product. Our clients, if they own junk silver, they need to give us a call.
Yeah, we're going to start putting the list together. Because I really think in the next 3-4 weeks, there may be a premium jump that you'd want to take advantage of.
And then you want to go out of bags into bars. How long have we been doing this? 50 years. We've been going bags to bars, proofs to bullion. We've been doing this forever. We'll play these premiums and let the market do what the market does, and we're going to gain ounces for our clients.
Sure. Hey, see, this is great. See, we started out negative because the world's falling apart. But then the trick is, and the thing we obviously like to do here is there's always opportunity.
Yep.
It's the silver lining argument, right? There's always a silver lining in every rain cloud. And there's definitely a silver lining here somewhere. If you're already a precious metals owner, you have your hedge. Like, I don't want to lose a cash position to a bank failure either, but I have a hedge. I would rather lose the little bit of money I've got sitting, also at Bank of Colorado, by the way, and I've got a Wells Fargo account too. So I've got one big bank, one small bank. I'd rather lose the little amount of money I've got there than lose everything. And I think some people are genuinely concerned at massive, catastrophic 2008 level losses again.
But there's so many people whose spouse will say, "But I feel safer with the money in the bank. I know how much it's worth." Gold and silver go up and down. And I understand that until they get to a point where they're losing faith in the financial system and in the currency. And it doesn't mean the whole world has to come apart. It doesn't mean it's the zombie apocalypse. It just means that people begin to say, "Hey, maybe it's not as safe as I thought it was. Maybe we should diversify."
Right. Yeah, and it's diversify. It's looking at dividing your assets up based on purpose.
Right. But it's true. You don't put all your eggs in one basket. Now, there is the difference between the chicken and the pig when it comes to breakfast. The chicken's involved, but the pig's committed.
Right. Okay, maybe I got to get some pigs next. I've been complaining about the expense of my chicken coop on this show for like 2 years until what egg prices did this summer. Now I'm grateful.
The girls had 4 eggs from me this morning. So I wouldn't encourage people to do what I have done because I'm all in on gold and silver. I mean, that's where I keep my money.
Still not calling you a pig.
No, I'm just committed. But at least people need to move. If you vision the triangle, you have a third of your money in gold and silver that you have in your hands or in your retirement plan that's real. And then you have a third liquid, bank savings, money market accounts, treasury bills, short-term T-bills. Our vaulted account is brilliant. People should be looking at that. And then you can keep a third of the money in the market for growth and income or real estate. But you have to be balanced. And that's the biggest challenge that people have because they make it such a big deal. Well, if I buy gold, it can go up and down. Well, how much do you have? Well, my financial advisor says 5 to 10%. I'm like, that's just paying lip service. If you have a third, that is your foundation. That's your insurance.
Yeah, I've got about 5 to 10% of my home insured through homeowners insurance. No, of course I don't.
Of course you don't.
You want to have a position in precious metals that's going to offset a catastrophic loss elsewhere. And that's the end goal of it and its main purpose. And if we can look at things like, say, the junk bag conversation we just had from time to time.
Take a bag of junk silver and get a 1,000-ounce bar. You go from 715 ounces to 1,000 ounces. Why wouldn't you?
Yeah, of course.
And then we go back to something else when the premiums get back to normal.
Maybe back into junk bags, but you get a bag and a half instead of a bag.
It can happen if this is just a short-term panic. Now, if it's long-term, you'll be able to take your profits from silver and back into gold when that ratio narrows from about, 78 to 1 right now?
Sounds about right.
80 to 1, somewhere around there. When it narrows to 50 to 1, or 45 to 1, then you can come out of your 1,000-ounce bars and into gold coins.
Yeah. Now, is this the reason to invest in gold? Of course not. You invest in gold first and foremost as that protective hedge. Like any good defensive coordinator on any football team, your job's to stop the ball moving down the field. But isn't it nice once or twice a game to get that interception?
Yep.
And that's what we're talking about when we try to work with our clients from, say, what we call, and you've heard us call, the ratio trading strategy.
It works.
So that's going to do it this week for Golden Rule Radio. We appreciate you sticking through. I know this was a light chart, heavy fundamentals, but there's not a lot to show on the charts this week because everything's down except the metals. The metals all had a nice little pop today. Everything else is down. The dollar's down, the equities are down, even yields on the treasuries are down.
And the values are down.
I take that back. One other thing is up, but we already talked about that, and that's the amount of money on the Fed balance sheet. So, gold and the Fed balance sheet, best two investments today. I really would recommend continuing to give us a buzz. We've talked to a lot of our clients over the last 2 weeks, a lot of our listeners, so I really appreciate the calls this past week. It's been fun getting to know some of you that have been listening for a while that maybe we've never talked to before, and a lot of our long-term clients that are listeners each week. We really appreciate you stopping by as well. So keep it up. Let's build a game plan. There's absolutely no reason to participate in the concern of what's happening over potentially the next couple months, maybe a few years. So again, if you liked what you heard, do the YouTube things. Buttons are below. As I just mentioned, feel free to give us a call, talk with Rob, myself, Tori, any of the other advisors here at McAlvany Precious Metals. We can be reached at 800-525-9556. You can find us on our website at McAlvany.com. We're on Twitter at ICA Gold or Facebook at McAlvany Financial. Thanks again. We hope you have a great week.